Life insurance policy provisions, options, and riders. Paid up additional option dividends can be used to purchase paid up editions of life insurance. These editions will be the same kind as the original base policy. The amount of the paid up amount that is purchased on each year is determined by the insured attend age, the amount of the dividend paid, and the type of coverage purchased. Reduced premium dividend option allows policy owners to use the dividend to pay all or part of the next premium due on the policy, sometimes called the reduction of premium dividend option. 1 year term dividend option, a fifth option that, though not utilized as frequently as the others, is to use dividends to purchase as much 1 year term insurance as possible. Policy riders. The flexibility of life insurance policies is demonstrated by the ability policy owners have to customize a policy to meet their specified needs. Imagine buying a car without being able to purchase an option such as air conditioning or GPS. Chances are good you might not even buy that car. Insurers offer their applicants the privilege of adding options in from the form of policy riders to their policy to meet their unique needs. Like new car options, policy riders are available at an extra cost, but justified because the increased value the riders give the basic policy. Most of the optional riders described below must be selected at the time the policy is applied for. The automatic premium loan rider, if it is an option and not standard policy feature, is the only option rider available at no cost to the policy owner. It can sometimes be added after the policy is in force. Guaranteed insurable option rider. This rider allows a policy owner to purchase additional life insurance coverage at a specific date without providing evidence of insurability. The rider provides specified dates on which additional life insurance policy can be bought. The policy owner can only translate purchases during these days. Usually, the older the insured gets, the fewer dates the policy owner has to purchase more life insurance. In some instances, after a certain age, this rider may not be available for purchase or to be added. The option amount is the maximum life insurance a policy owner can buy on specified date, optional date. The policy owner can buy this option amount or less on the optional date or none at all. However, the optional amount cannot be added from one optional date to another if the earlier option date was not exercised. Costs for new coverage policy under these riders are calculated on the basis of insured attend age. This rider also will be allowed the policy owner to purchase additional coverage at marriage or birth of a child. Waiver of premium rider. The waiver of a premium rider provides valuable added security for policy owners. It can provide a policy from lapsing non-payment premiums while the insured is disabled or unable to work. The waiver of premium rider is available on both permanent and term life insurance policies. If the company determines that the insured is totally disabled, the policy owner is relieved of paying premiums as long as the disability continues. Some companies include the waiver of premium as part of the contract with the cost built into the overall premium. In other companies, the waiver may be added to a policy by rider or endorsement for a small additional premium. Some policies specify that an insured must be totally and permanently disabled for the waiver to take effect. It does not apply to short-term illness or injuries. In fact, an insured generally must be seriously disabled for a certain length of time, called the waiting period, usually 90 days or 6 months. The policy owner continues paying premiums during the waiting period. If the insured is still disabled at the end of the period, the company will refund all the premiums paid by the policy owner from the start of the disability. The company then continues to pay all premiums that become due while the insured disability continues. If the insured recovers and can start back to work, premium payments then must be resumed by the policy owner. No premium paid by the company has to be repaid by the policy owner. For the waiver to become operative, the insured must meet the policy's definition of totally disabled. Totally disabled may be defined as insurability or engagement in any kind of work for which the insured is reasonably fit by education, training, or experience. With some policies, the definition is wondered in terms of the insured inability to work at the insured own occupants for a stated period, for example, 24 months, at any occupation. Therefore, after a waiver of premium, riders generally remain in effect until the insured reaches a specified age, such as 60 or 65, when the provision expire. The policy premium is reduced accordingly. If an insured becomes disabled prior to the specified age, all premiums usually are waived while the disability continues, even though premiums falling due after the insured passes the stipulating age. Although premiums are waived for a disability insured, the death benefits remain the same. In addition, the cash value will increase as the normal rate and dividends for participating policies are paid as usually. In fact, cash values continue to be available to policy owners at the time at which the insured disability continues. Automatic premium loan rider. The automatic premium loan features discussed earlier in this chapter is standard features in some life insurance policies. In other, it provides an addition to the policy by rider. In either case, if it's available to the policy owner at no additional charge, as previously noted, it allows insurers to pay premiums from the policy's cash value if premium has not been paid by the end of the grace period. These deductions come from cash values, are treated as loans, and are charged interest. If these loans are not repaid, the interest will also be deducted from the cash value. Should the insurer die, the loan plus the interest will be deducted from the benefit payee. Automatic premium loan provides that as long as premiums are not paid, the loan procedures will be repeated until the cash value of the policy is exhausted. When the cash value is depleted, the policy lapses. An automatic premium loan option can be elected at the time of an applicant or when some insurer added after a policy is issued. Payer provisions or riders. A note earlier in this discussion of juvenile insurance, payer provision is usually available, such as policies providing for a waiver of premiums. If the adult premium payer should die or with some policy become totally disabled, typically this policy provision extends until the insured child reaches a specified age, such as 21 or 25. Accidental death benefit rider. The accidental death benefit rider, sometimes called a double indemnity provision, provides additional amounts of insurance, usually equal to the face value of the base policy. If the cause of death was an accident, consequently the insured died as a result of an accident, and the insured has a double indemnity rider, the total benefits paid will be double the policy's face value. A triple indemnity provision would provide a total death benefit of 3 times face value. Any policy loans are subtracted from the policy face amount and not from accidental death riders. Accidental death is strictly defined. It does not include accidents resulting directly or indirectly from ailments or physical disabilities related to the insured. The additional proceeds are paid only if the insured dies as a result of bodily injury from some external violent and purely accidental cause. Also, death must occur within a specified time, usually 90 days following the accident. Death that might be considered accidental, such as resulting from self-inflicted injury, war, or private aviation activities are excluded. As accidental death provides an additional death benefit for a limited period of time at the lowest possible cost, many companies do not offer accidental death benefit to anyone older than the age of 55 or 60, and the extra protection generally expires after the insurer reaches age 60 or 65, while in effect the additional insurance does not build any cash value. The extra premium for this benefit is not paid beyond the date when the additional benefits expire, nor does the benefit apply to any paid up additions that may be purchased with policy dividends. The benefits also drop off in the event that a policy owner surrenders the policy and selects one of the non-forfeited options. Return of premium rider. The return of a premium rider provides that in the event of death of the insured within a specified period of time, that the policy will pay, in addition to face value, an amount equal to the sum of all premiums paid to date. In actuality, this rider does not return premiums but pays an additional benefit equal to premiums paid upon the date of death. The policy is simply purchasing term insurance that increases as the total amount of the premium pays increase. Many insurers now offer a return of premiums to a living policy after a specified time. There are also returns of premiums, ROP, policy that is a whole life insurance policy which increases term insurance riders equal to the amount of premiums paid. If the insurer dies within the term period, the beneficiary will receive face value plus value of all paid premiums. Cost of living rider. Some companies offer their applicants the ability to guard against the eroding effects of inflation. The cost of living, COL, or cost of living adjustment, COLA, riders can provide increase in the amount of insurance protection without requiring the insured to provide evidence of insurability. The amount increase is tied to an increase in inflation index, most common only the Consumer Price Index, CPL or CPI. Depending on the type of basic policy, these riders can take several different forms. Long-term care rider. Long-term care rider can help safeguard against financial burden of long-term care. The rider provides an acceleration of death benefits to help pay for the costs involved with long-term care. Under normal circumstances, an insured would require assistance in at least 3 activities of daily living, ADLs, to be eligible to receive benefits. Benefits are typically paid out income tax-free, with the result both death benefits and cash surrender values of the life insurance policy.